Hi, I'm Adam Brown, head of ETF distribution for PIMCO. In today's uncertain economic environment, advisors are increasingly turning to flexible investment products. We've seen that play out as PIMCO's Multisector Bond Active ETF, ticker symbol PYLD, has become one of the industry's fastest growing active bond ETFs and a fixed income staple in many investors' portfolios. My colleague and portfolio manager, Sonali Peer, will review the market opportunity and why PYLD may be a fit for advisors and fixed income investors.
We've seen a lot of volatility this year as markets quickly adjusted to tariff announcements. The starting level of yield remains elevated and a good indicator of potential forward returns. While many fixed income markets have rebounded, significant uncertainty remains as investors grapple with the full economic impact from tariffs, other policy changes, and ongoing focus on deficits. As a result, we continue to emphasize the attractiveness of high-quality fixed income, remaining up in quality to potentially provide resilience. That said, volatility can create dispersion and overshoots, leading to a target-rich environment for active management. The flexibility and liquidity in this portfolio enables us to stand ready to deploy capital when we see dislocations. PYLD, ticker PYLD, is an active multi-sector credit ETF that we launched in June of 2023, and it's quickly become one of the fastest-growing active ETFs in the industry. We believe it is well-positioned to navigate today's challenging and volatile market environment. PYLD is designed to invest across a broad opportunity set of spread sectors, offering access to diversifying exposures in unique areas of the fixed income market. PYLD focuses on expressing PIMCO's strategic relative value views across spread sectors, coupled with active management of duration, which is especially appealing given the ongoing elevated interest rate market volatility. PYLD's full credit and macro toolkit is an important feature, with the ability to actively manage credit relative value and macro volatility through the level of duration, diversifying to global duration, and curve positioning. This flexibility and resiliency are increasingly important given elevated uncertainty. We've made meaningful changes to our allocations since inception, as our strategic relative value views have evolved. Heading into the volatility in early 2025, we leaned into higher quality areas of the opportunity set, such as agency mortgages and securitized, and have de-emphasized corporate credit as spreads were tight. This put the portfolio in a resilient position to weather the volatility in early April, and we haven't had to make large, drastic, or reactionary allocation changes as a result. While corporate credit did widen during the risk-off moves in April, even at the local wides, spreads were still pricing in muted recession probabilities, such that valuations didn't warrant materially adding risk. At the same time, we saw other high-quality credit areas, like agency mortgages, widen alongside corporate credit, and so we incrementally added positions in agency mortgages. We've been quite active in the portfolio on duration, as rates have remained volatile. We employ a toolkit that includes overall level of duration, but also areas like curve positioning and looking globally across interest rate markets. Our duration positioning is not a simple sum of our bond holdings. Rather, we've been actively changing our duration positioning as we see opportunities given the interest rate volatility. We've dynamically managed where to source our duration through regional diversification. And we're finding opportunities in high-quality interest rate markets such as the UK and Australia. These markets are more sensitive to high policy rates and should see additional easing. We also have tips in the portfolio as an inflation hedge, as we believe markets continue to underprice the potential for structurally higher inflation. Additionally, we see many factors such as high deficit spending and debt to GDP ratios driving higher back-end rates and a greater term premium. And therefore, we employ a curve steepener in PYLD.
By design, PYLD has an exceptionally broad mandate. We see advisors and investors using PYLD in three ways. First, as a standalone multi-sector solution. Instead of juggling multiple single-sector strategies, many investors are finding that PYLD offers a comprehensive solution, providing access to unique spread sectors all in one place. Second, as a complement to traditional core and indexed exposures, PYLD can serve as an addition to traditional core and core plus portfolios, which are more rigid in their positioning with duration and across sectors. Adding diversified spread sectors and increased flexibility can help to enhance overall portfolio resilience. And finally, as a diversification tool versus higher volatility sectors. For those looking to balance out higher volatility sectors such as equities, high yield, and bank loans, PYLD can serve as a solid diversification tool, allowing investors to pursue elevated yield and return potential without taking on excessive risk.